Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. If you have questions or topics you'd like to discuss, please chat that over now so we can be sure to get to them. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. All right, so welcome again to our daily Solo 401k webinar and Q&A session with my Solo 401k Financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic is Solo 401k for 1065 partnerships, the critical 1231 deadline demystified. This is your chance to get answers. Please use the chat now to chat over questions or topics, whether on this topic or either unrelated topics. Please chat them over now or as we go through the slides so that we can be sure to get to them all. All right, let's get started. So let's lay the foundation with eligibility. So in order to be eligible to set up a solo 401k, it's not always clear, but there are clear requirements, right? It'll depend on the facts and circumstances. So one requirement is that you need to be self-employed. So the way that you prove that you're self-employed is by reporting earned self-employment income on your taxes. So this could be income, for example, reported on Schedule C if your business is taxed as a sole proprietorship, or a single member LLC taxed as a sole proprietorship. Let's say your business is taxed as an S Corp or a C Corp. In that case, you would demonstrate earned self-employment income by receiving W-2 wages from your business taxed as an S Corp or a C Corp. Let's now assume that your business is taxed as a partnership. Earned self-employment income is income reported on line 14 of the K-1 that you receive from your business tax as a partnership. In other words, a business that files a Form 1065 partnership tax return. That's one element of the eligibility criteria. The other element, and you got to satisfy both, is that you cannot have any non-owner, non-spouse, full-time W-2 employees. So let's break that down. So there can be other owners of the business, as long as they own at least 3% of the business, who are working in the business, and the fact that they're working in the business is not going to prevent the business from setting up a solo 401k. There can be spouses, regardless of whether they own part of the business, who are working in the business, and that's not going to prevent the business from setting up a solo 401k. What would prevent the business from setting up a solo 401k is if there are not non-spouse, non-owner, full-time W-2 employees. So that means that the business could have 1099 independent contractors, and that wouldn't prevent the business from being able to set up a solo 401k. It could even have W-2 employees who are not working on a full-time basis. In other words, they don't work at least 1,000 hours per year with 1 year of service, or 500 hours per year for 2 consecutive years. So if those criteria are met, the business could set up a solo 401k plan and then access all the benefits of setting up a solo 401k plan. Now, one of the top benefits of setting up a solo 401k plan is that a solo 401k plan has the highest contribution limits for any defined contribution plan available to self-employed individuals. And the reason for that is, in the words of the IRS, is that the self-employed person is both the employee and the employer. That person wears both hats. That means that that person could make both employee contributions as well as employer contributions. So they got multiple buckets that they could fill up. And then on top of that, if you have a solo 401k plan, like the one offered by my solo 401k Financial, then you could make voluntary after-tax contributions to the plan, because our plan allows for those voluntary after-tax contributions. And then you could transfer those voluntary after-tax funds either to a Roth solo 401k or a Roth IRA, where they could have that potential for tax-free growth, just like any other funds in a Roth account. And that strategy, that two-step process of making an after-tax contribution and then transferring the funds over to a Roth solo 401k or Roth IRA is referred to as a mega backdoor Roth. So that's another feature in terms of contributions that is available to solo 401k plans that allow for those mega backdoor Roth solo 401k contributions. Another great feature of solo 401k plans generally is that you have more time as a self-employed person to be able to determine how much you're going to contribute and then actually deposit those contributions. You have until your self-employed business tax return deadline to make contributions, provided that the plan is established by the end of the year. So that's where the critical December 31st deadline comes into play. So if the plan is established by the end of the year, and we'll talk about what it means to establish a plan. But if the plan is established by the end of the year, that'll preserve the ability for that self-employed person to make all types of solo 401k contributions, whether they're looking to make employee contributions, employer contributions, and or mega backdoor Roth contributions. And they will have time to not only make those contributions, but also open up accounts, because all that it means to establish a plan is to establish the documents, because that's what a 401k plan is. It's a legal entity. A 401k plan is a legal entity. It's a trust. And like any legal entity, it's the documents that create it. So we at My Solo 401k Financial make it super easy to meet the deadline, because we create the document specifically for your business within the same business day when someone signs up. And then that person can take their time to open up the accounts, make the contributions, all the way up until their 2025 business tax return deadline, including extension in 2026. Now, specifically for a partnership, what are the deadlines? Well, if you sign up by the end of the year, by December 31st, 2025, you preserve the ability to make all types of contributions, whether employee, pre-tax and Roth, employer, pre-tax and Roth, because our plan allows for both pre-tax and Roth, employee and employer, and or voluntary after-tax contributions, which is again how you make mega backdoor Roth contributions. That individual, where their business is taxed as a partnership, will preserve the ability to make all types of contributions, all those contribution types, by their partnership tax return deadline, including any timely filed extension. So for 2025, the 1065 deadline for a partnership that files on a calendar year basis is March 16th, because the 15th falls on a Sunday, or September 15th of 2026, if they file a timely extension for that Form 1065. Now, let's assume that they don't set up the plan. They don't sign up by the end of the year, which really we make it so easy to do. It's just in the same business day, but let's say that they're not able to do that. Can they still make some types of contributions for 2025? Yes, but they'll lose the ability to make all types. Specifically, they'll lose the ability to make employee contributions for 2025. So if they don't establish the plan until 2026, they'll only be able to make employer and or voluntary after-tax contributions by the business tax return deadline, including extension, in 2026. So March 16th or September 15th of 2026, if they file a timely extension for that 1065. Now, how do we make it so easy? Well, it's just 3 simple steps. The individual just needs to sign up. You just need to sign up on our website. It's just 10 simple questions and make payment. You can easily and quickly sign up at mysolo401k.net. Just click on open account, click on solo 401k, submit the information. It's information that is going to be readily available. Just information such as your name, your address, the name of your business, how your business is taxed, right? What you want to call the plan. And so it's best to use 2 words in the word trust. Once we capture that information, let's say you called it Simple Wealth Trust. Then we'll prepare the documents for your business within the same business day. We draft those documents within the same business day. An email goes out with a link to the secure portal where you can download the documents that are drafted specifically for your business, sign the documents, and you've met the deadline. You don't need to return the documents to us by the end of the year. You don't need to open up accounts by the end of the year. You don't need to make contributions by the end of the year. You could take your time in 2026 to determine how much you're going to contribute, to make those contributions, to open the accounts. And when you're ready to open up the accounts, we're here to help you do that. At that point, you would just submit the documents, submit our next steps questionnaire. There'll be a secure upload link in that email. There'll be a link to the next steps questionnaire where you tell us where you want to open up the accounts, because we don't hold or have access to any of our customers' money. But at the same time, we're very hands-on in helping customers open up accounts at the bank or brokerage of choice. We'll be there, for example, prepare the paperwork to help you open up the requisite number of accounts. But again, you can take your time to do that in 2026 as long as you sign up by the end of the year. So completing those steps is going to give you all the options, the most time to make all the different contribution types for 2025, but in 2026. Now, let's again just review those steps. So step one, submit the online application. This is how we collect the information about you, about your business, what you want to name the plan. Again, 2 words in the word trust for a total of 3 words. Once we capture that information and you make payment, we draft the plan documents. Using our IRS approved plan documents, we draft the plan specifically for your business. So that's going to be, for example, the adoption agreement, the trust agreement. We provide you a copy of the IRS favorable determination letter that confirms that the plan is a qualified plan. When you make contributions, you want to make those contributions in a qualified plan or to a qualified plan so that you can take the tax deduction, for example. So we draft those plan documents. We send an email with a link to the secure portal where you can download the documents. You can sign the documents. You can use an electronic signature software if you have that. That's totally acceptable from a solo 401k perspective. And now you've met the deadline, right? You can take your time to open up the accounts, to make the contributions. When you're ready, there'll be a secure upload link in that same email that you can use to return the completed and signed pages. You submit the next steps questionnaire to tell us where you want to open up the accounts. Let's say you choose Schwab, just to pick an example. We'll draft the paperwork that Schwab requires to open the requisite number of accounts. We'll send you another email with a link to the pre-filled paperwork to open up those accounts at Schwab. You would download, you would sign, you would upload, then we would review and compile and fax the paperwork to Schwab's back office. Schwab would then send you an email when the accounts are open. Only you have access to the accounts, not us. And then you could start making contributions. And we field questions every day from customers in terms of how much they can contribute based on their situation. In addition, you could fund those solo 401k accounts by rolling money over from pre-existing retirement accounts, as long as it's eligible to be rolled over. So eligible accounts would be all types of pre-tax IRAs. So a traditional IRA, pre-tax money in a SEP IRA, pre-tax money in a simple IRA, pre-tax and Roth money from a qualified plan. So let's say you have a former employer 401k that has both pre-tax and Roth money. That can be rolled over to the solo 401k. What you cannot roll over because of the Roth IRA rules are funds in a Roth IRA. Under those Roth IRA rules, you cannot transfer Roth IRA funds to any type of solo 401k or any type of 401k, including a solo 401k. So what do I have to do by December 31st? You have to sign up. And that's what establishes the plan. That's what preserves your ability to make all types of contributions for 2025 until your business tax return deadline, including extension in 2026. Do I have to open the bank or brokerage account by December 31st, 2025? No, you don't. That's not what creates the plan. A 401k plan is a legal entity. It's the documents is what creates it. And per IRS publication 560, all that's needed to establish the plan, or all that's needed to preserve the ability to make contributions by the tax return deadline, including extension in the following year, is to establish the plan. And the way that you do that is through the documents. So no, you don't need to open up the accounts. You don't need to obtain an identification number for the solo 401k. Now, we do obtain an employer identification number specifically for the solo 401k as part of the process, but that's part of the account opening process. That EIN number that's obtained specifically for the solo 401k, which is different than the EIN number, for example, that you might have for your LLC tax as a partnership, that EIN number for the solo 401k, that can be obtained in 2026, because again, that's part of the account opening process. Is the tax return deadline my personal tax return deadline or my self-employed business tax return deadline? It's the self-employed business tax return deadline. So for a business tax as a partnership, that's March 16th of 2026, since the 15th falls on a Sunday. Or if you file a timely extension for that Form 1065, that'll give you more time. That'll give you till September 15th of 2026. And then again, you can make all types of contributions for 2025, whether employee, employer, or voluntary after tax by those dates in 2026, as long as you just sign up by December 31st. If I adopt the plan in December 2025, how can I make contributions based on income that I earned in January 2025? Well, the industry standard, our practice, is for the plan to be effective as of January 1st, 2025. So that's going to allow the individual to make contributions for 2025 for any self-employment income earned and reported for 2025. My CPA tax advisor is informing me that the employee contribution must be made by December 31st, 2025. Are you sure that I can make this contribution in 2026? This is a common point of confusion because the employee contribution deadline for a full-time employer plan. Let's say you have a 401k plan through a W-2 job, right? You work in corporate America. In that case, those employee contributions do have to be made by the end of the year. But the rules are different for solo 401k plans. The rules are different for self-employed individuals. And again, this is clear per IRS Publication 560. IRS Publication 560 is the landmark guidance for self-employed retirement plans like solo 401k plans. And per that guidance, as long as the plan is established by the end of the year, that'll preserve the ability to make all types of contributions for 2025 up until your business tax return deadline, including any timely filed extension in 2026. And the logic behind that is that self-employed individuals oftentimes don't know exactly how much they've made until after the end of the year. So giving them additional time makes sense from a policy perspective because your ability to contribute is based on how much you've made. Can I make a Roth conversion for 2025 anytime up until my tax return deadline in 2026? Well, let's define a Roth conversion. A Roth conversion is not a contribution. Up until now, we've been talking about contributions. A Roth conversion is where you take money that's already in your solo 401k. It's in that pre-tax solo 401k account. It could have been a previous contribution that's now in your pre-tax account, or it could be pre-tax funds that were rolled over from another retirement account, such as a pre-tax IRA or pre-tax money that was in, say, a former employer plan. And now you want to convert that money from a pre-tax status to a post-tax status. You want to move it from the pre-tax account to the Roth account so that then it can grow on a potentially tax-free basis. So that conversion needs to be taxable because it's going from a pre-tax status to a Roth status to a post-tax status. So that will be taxable for the year of the conversion. So if you want that to be taxable income for 2025, you would need to make the conversion by December 31st, 2025. So you'd have to literally transfer the funds by December 31st, 2025. All right, that takes us to the end of the slides that we wanted to share. Let's now turn to the great questions. Thank you so much for bringing them. One second. And if you have more questions that have come up, please chat them over now so that we can be sure to get to them. Okay, so my New York single member LLC short-term trading gains can constitute income. It's on Schedule C for purposes of solo 401k tax deductions. So how you report income is a question for your tax advisor. But if that income was reported on Schedule C, then it could be used as a basis to make solo 401k contributions. Is the $70,000 solo 401k contribution for 2025 reduced by the fact that I have a 401k from my full-time employer that I've maxed out the contributions? That's a great question. It's a common question. And so remember, there are different buckets that you can fill up when you're making contributions to a solo 401k. One is the employee bucket. So, for example, the limit for 2025 in terms of employee contributions is $23,500 or more if you're age 50 or older. So the employee contribution limit applies at the employee level. And so if those contributions have been maxed out to a day job 401k plan, the self-employed individual is not going to be able to make any more employee contributions to the solo 401k. But the employer contribution limit, the voluntary after-tax contribution limit, the overall contribution limit of $70,000, which comes from 415C, the section of the code, that limit, those limits, the employer, the after-tax, the overall limit, is not reduced by contributions made to a plan that's sponsored by an unrelated employer. So it's a plan that's sponsored by your W-2 employer. You just work there, you don't own it, right? So if that person has enough self-employment income to justify those employer and or voluntary after-tax contributions, they could make an additional $70,000 of contributions to the solo 401k, and it would not be reduced by the contributions made to the day job 401k plan. Now, the exception to that rule is the 403B exception. So under the 403B exception, all contributions made to the 403B, whether employee or employer, together with any contributions that they want to make to the solo 401k, the sum of those contributions, the 403B, plus the ones that they want to make to the solo 401k, cannot exceed the overall limit. For example, $70,000 for 2025. Hopefully that makes sense. Yes, we can send you the email, the steps in an email format that you can send to your client, most definitely. We'll pull up your email and respond accordingly. Thank you so much for attending today's session, and please don't hesitate to chat over any more questions. And we'll be having a webinar regarding those solo 401k contribution limits. But yes, they were raised. The official notice came out late this year because of the shutdown. But for example, the employee limit was raised from 23,500 to 24,500. For example, the just to give one example, the overall limit was raised to 72,000, for example. But we're going to have a deep dive discussion on those limits. So please subscribe to the channels so that'll be coming out soon. Yes, and we recently hosted, thank you so much. We're totally compatible, you know, with advisors because we're neutral as far as where the accounts are opened up at. So we have plenty of customers who work with LPL advisors. So you can definitely have the accounts at LPL, but have the plan documents provided through us. So now you can access all the features, all the advanced features of our plan, whether it's the mega backdoor Roth, the ability to take a solo 401k loan, the $1,500 in tax credits, just to name a few. Let me grab, for example, one of the webinars we hosted regarding compatibility with LPL. One second, please. Thanks so much for joining. And just while I'm pulling up that LPL video, If this information is helping you feel more confident about your future, please take 1 second to like and subscribe. Liking is going to tell the platform that the content's valuable, whether you're on LinkedIn or Instagram or YouTube or X. And so that way others can find it, whether it's other advisors or other solopreneurs like you. And if you subscribe, you'll get notifications of all of our crucial content that we deliver every day to help you secure your retirement. We do go live every day. Exactly, because they also raised the catch-up contribution limit. You're exactly right. So if you're under 60, you can do 8,000. You got to have, of course, the self-employment income to justify it, but 8,000 catch-up plus a 72,000 overall limit. That'll take you up to 80. It all depends on, yeah. So I think we answered the second question already about the uh, the impact to the overall limit from contributions made to a day job employer 401k, that it's not, doesn't reduce the $70,000 limit because it applies at the plan level. As far as that third question, it all just comes down to how that income is being reported. It's got to be reported as earned self-employment income to justify contributions to the solo 401k. So that would be, for example, on Schedule C. So if that can be, so you would have, now how you report your income, of course, is a function of, it's a question for your tax advisor. So you have to answer that question with your tax advisor first. But if yes, in other words, if it is reported as earned self-employment income, then yes, it could be used to justify contributions to the solo 401k. Let us know if there's any additional questions. We want to take a moment to invite you to our community. We have the largest community of solopreneurs, solo 401k owners, other interested parties like advisors around these topics, which means we've got vibrant forums. We've got over 30,000 members. So there's vibrant forums, there's a library of videos and webinars. It's totally free to join. All are welcome. You can easily and quickly join at mysolo401k.net/my community. So please don't hesitate to join now. And we look forward to seeing you over there. Thank you. If I do the solo 401k with my single member LLC with LPL, would you also be able to do the mega backdoor Roth solo 401k? So there would be one solo 401k plan, meaning the documents provided by my solo 401k financial, but the accounts would be over at LPL. So you'd have different sub accounts at LPL. For example, one for pre-tax, a second for Roth, a third for after tax. So those different sub accounts are part of the one plan. So it's one 401k plan, but you might have different participants. Like, say, if there's a husband and wife that are both working in the business, or different accounts. For example, if there's pre tax, Roth, and after tax. Now, each of those accounts would need to be opened up under the EIN number and name of the plan. So, as part of the onboarding process, we obtain an EIN number specifically for the solo 401k, and that can be used to open up those accounts. So individuals are going to be able to, so if you have, say, a single member LLC that you operate, the individual operates a certain services business through, and there's no employees working for any business owned by that person or a spouse, if any, and that's the entity that's listed on the application. So that's the entity, therefore, that's listed on the solo 401k plan documents. that individual is going to be able to aggregate other sources of self-employment income. So for example, we have many clients that are serial entrepreneurs. So if you got multiple sources of self-employment income, the individuals will aggregate from all sources of self-employment income to justify contributions to the solo 401k. So it doesn't mean they set up multiple solo 401k plans. They just have one plan, but they aggregate all that income to justify contributions to that one plan. Hopefully that makes sense. All right, looks like that's it for today's session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. Please like and subscribe so we can keep building the solo 401k community. We'll be back here tomorrow with more crucial content to help you secure your retirement.